For Morningstar, I'm Jeremy Glazer. Oil majors like ExxonMobil and Chevron have been seen as relative bastions of safety in a tumultuous oil market. I'm here with Josh Peters. He's the editor of Morningstar's Dividend Investor for his take on their dividend-paying potential. Josh, thanks for joining me.
Good to be here, Jeremy.
So I know we recently had analyst days for both ExxonMobil and Chevron. When you look at their positioning in the market right now, do you still think that they're going to be able to withstand the turmoil we've seen in energy?
Well, a lot of it, unfortunately, comes right down to the oil price. And if you're at sub-$40 oil, even Exxon may run a deficit after it's paid its dividend. It's not going to generate enough free cash flow in order to fully fund that dividend. Now, over a shorter period of time, couple of years, if oil prices don't recover, what you have with Exxon and with Chevron, which I own and have owned for a number of years, I haven't owned Chevron or haven't owned Exxon before, that they have the balance sheet capacity to finish their big capital projects. CapEx is going to fall. That's going to help cash flow. They have the ability to cut costs. You know, they can do a lot of things at once. You know, that's the advantage of having these very strong balance sheets in a cyclical industry going into the down part of the cycle. But at the end of the day, you know, the most important margin of safety for these stocks is excess coverage for the dividend, either on a free cash flow basis or an earnings basis. I frankly would prefer both. And at this point, both companies need a rebound in the oil price, in addition to all of the cost cutting that they've put on the table in order to really make these existing dividend policies work over the long run. That's not the greatest position to be in from the standpoint of a dividend investor. I'd still rather be with these two names, one or other, again, I own Chevron, than with a ConocoPhillips, which has already cut its dividend, or BP, Shell. I mean, these are dividends that look very vulnerable to me.
You mentioned cost cutting. Do you think that the spending less on CapEx is going to result in slower growth in the future? Is it going to restrain dividend growth?
That's going to depend. I mean, part of the cost cutting that goes on in these businesses is automatic. You know, say oil price comes down, you pay less in royalties and taxes. So some of it is indexed directly to the commodity price. On the capital side, you know, for a while there, it was, you know, drill, drill, drill. Everybody in the world was trying to expand production as fast as they could to meet demand in this $100 plus oil environment. And that meant that service providers could run up their prices because there was more demand than supply of oil services, drilling services. Now that budgets are being cut everywhere, you also have the opportunity for those who are still maintaining some drilling activity to take advantage of lower prices. So that's an advantage. But you know, there are only so many projects, even for an Exxon and a Chevron, that are really economically viable at these low oil prices. And if they're not spending because they don't have the opportunity, they don't have the cash flow in order to do it, and they don't have projects that are providing a good return on and of capital at, say, $30 oil or $35 oil, then that's definitely going to take a toll on their ability to grow. That really gets to the heart of some of my concerns here, is that even if their dividends are safe, and I think Exxon's in particular very unlikely to be cut, a little bit more risk at Chevron, but I think they've got the capacity to see through another couple of years of low oil prices before they'd have to really consider the dividend rate. It's more that what's the growth component here that I'm pondering.
So if you think it's safe, but maybe won't grow, and there's these other risks out there, should investors consider these oil majors, or dividend investors consider them, or are there other parts of the market that maybe are more attractive?
I think you have to really start, like I always do, from the standpoint of what am I trying to achieve with my portfolio as a whole. And for a lot of years here, I've owned these. Well, I used to own Shell, still own Chevron. Again, saying that again for like the sixth time. I own Chevron. I felt like there was some value in a hedge, that almost all of us, unless we're off the grid in a cave in Montana someplace, are consumers of energy, consumers of petrochemical products. Why not have some hedge against a supply shock or a future of very high oil prices? You know, that these stocks could essentially punch a little bit above their weight, contribute more to the portfolio from a risk management standpoint than just in terms of dividend yield plus dividend growth. I am not really persuaded of that value at this point, just because we've seen how commodity price dependent the total returns these stocks can offer is. So at this point, I look at Exxon with a mid 3% yield, a Chevron with a high 4%, maybe 5% yield, depending on the day. You've had a lot of volatility. I still need a lot of dividend growth from each of these companies over the long run to really feel like I'm being compensated for the risk that I'm taking. And if you want to make a directional bet on oil prices, there are better ways to do that. You could buy oil futures. You could buy an oil ETF. You could buy smaller, higher cost, highly levered E&P companies that would give you the maximum bang for the buck in an upside oil price scenario. So I'm kind of questioning that. Other than just a reliable dividend that has a big yield right now, am I getting enough from these oil majors to really make them work for my strategy? I'm still thinking about it, but I have come at least this far that I don't really consider Chevron a core holding anymore. And I think that you could have a portfolio of dividend-paying stocks that could serve your real-world needs quite well without having to have this energy exposure. It's the same approach I have to technology. I don't own any tech stocks. I don't think a dividend-oriented investor needs tech stocks in their portfolio. You might need utilities. You might need REITs. You might need some staples. But it's basically a matter of risk-reward. And if these stocks aren't moving you closer to your objectives, you don't really need them for any other reason.
So you don't need to see the fall in oil prices as necessarily an opportunity?
No, I'm not looking at it as an opportunity. I'm looking at it more as, an opportunity to deepen my thinking about risk management for my strategy. That this risk of an oil price collapse was always there. The margins of safety so far have proved sufficient, but if it's lower for longer in oil, then these are stocks I may yet regret owning. And I never like to be in that position. Of all the stocks I own right now, including a couple of midstream names, Chevron is still, even after the Analyst Day, which I thought was fairly positive, is the one I'm still most concerned about in terms of the threat to the dividend cut, as well as just the threat, lingering challenge of perhaps really poor dividend growth over an extended time horizon. I don't have an answer for you yet, but these are decisions, at least framing the question, I think, coming at these stocks is something that's very important for every investor to do if they're interested.
Josh, thanks for the update.
Thank you too, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.